And welcome everybody to Gentlemen of Action, your channel that covers finance, business, self-improvement, and other articles and news that will always keep you in the action. My name is Armando Cuervo, and I wanted to talk about something that has been basically in the news every day, almost every hour, which is that the Federal Reserve is looking to increase interest rates. And it's because interest rates are pretty important to the economy because basically when the Federal Reserve hires its interest rates, everything becomes more expensive to take out. Basically, you want to take out a mortgage, an auto loan, or refinance something, or take out a personal loan. It will cost more money to take out that debt. And because of that, a lot of people are freaking out because by increasing interest rates, it's going to lower the demand for a lot of important products like mortgages, auto loans, and installment loans, which means that in an economy that runs basically on debt, whether you love it or not. That's kind of how the American economy works. And that's how a lot of economies actually work, is that people take out debt and then it fuels the economy and it makes it more prosperous. Love it or hate it, that's just how the system works. So, all that being said, let's go into the article here as reported by the Wall Street Journal. It says here, Fed official leaves door open to larger rate increase in March. All right. Let's continue. Federal Reserve Governor Michelle Bowman said Monday she has an open mind over whether the central bank should kick off interest rate increases next month with a larger half percentage point rise. Okay, so basically all this hoopla that we're getting is because they want to increase the interest rates because they're saying that inflation's out of control. Currently it's at 7.5%. I mentioned that in a different video, and basically if you have a pulse, you've heard that inflation has been going up and it's currently at 7.5%. So one of the tools that's used by the Federal Reserve in order to tame down demand for products is by increasing interest rates, because when you make items and things more expensive to take out debt for, it typically slows down or stops a overheating economy. At least that's the concept. So that's why they want to increase it by, in this case, 0.25%. Though this Federal Reserve chairman, or one of the many governors, is saying that, hey, we might want to kickstart it faster by making it a 0.5 percentage point. And here's something important that they mentioned here, which is that the Fed typically raises rates in 0.25 percentage point increments and hasn't made a larger increase since 2000. So the reason why there's a big deal is that they haven't done 0.5 point increases or anything above 0.25% at a time in over 22 years. So allegedly, this inflation is the worst that it's been in over 40 years, yet they don't want to take a bigger step. Now, I don't really want interest rates to go up. I'm just saying that the idea that the mindset that they have, or the logic that they're having, maybe they're just making a whole lot of nothing, or they just want something to write on the President's Day. Because, today's President's Day, at least that's when I'm recording this, and I guess there's nothing else to talk about because everybody's out of session right now. Anyway, it says right here, consumer prices in January rose 7.5% from a year earlier, reaching a new 40-year high. As I mentioned, elevated inflation has been primarily driven by brisk demand for goods and shipping bottlenecks and shortages for intermediate goods such as semiconductors. But prices in January firmed up in the service sector. So they got it half right. Yes, the demand for goods made inflation very high because people needed stuff. And because they want stuff and there's a shortage of stuff, that makes things more expensive. But they also use that as the excuse to say that inflation was transitory. And we all remember what that meant, which is they're lying, folks. It was not transitory. It was here to stay. They don't talk about the money printing, but let's continue on. It says here, Ms. Bowman says she supported the Fed's decision at its meeting last month to signal a need for higher interest rates. And she said the economic data since that meeting has only increased the urgency to get on with the process. Meaning she's threatening to make it a 0.5 point interest rate increase, which, no, it's going to be 0.25%. They're just doing this out of a lot of hoopla. But let's continue. In this case, with the process of raising interest rates and significantly reducing the size of the Fed's $9 trillion asset portfolio. She said she expected additional rate increases would be warranted after the Fed's March meeting. Okay, I'm going to go into the $9 trillion in just a second. We'll just finish a little bit more here. It says here, Ms. Bowman said she expected current levels of uncomfortably high inflation will persist through the middle of this year, which is probably true because even when you raise interest rates, it takes time for that to cycle to the economy. So it's not going to be an immediate fix. Almost nothing is. And that she saw a substantial risk that high inflation would continue beyond that. Yeah, we're probably going to have inflation for another year. It's just what it is. An increasingly tight labor market, which didn't sustain serious damage from the Omicron variant of the coronavirus, suggests wage pressures aren't likely to moderate soon, she says. Yeah. Anyway, that's about the knack of the article. I mean, it was said here that one of the governors of the New York Fed said that there's really no kind of compelling argument that you should have to be faster right in the beginning with rate increases, Mr. Williams told reporters on Friday, meaning that other governors are saying that you really shouldn't start with half a percentage point as opposed to a quarter percentage point, which allegedly, if this is the worst inflation, you would think they would just start with the half, but it's because they just don't want to tank the economy. And there you go. That's the article. That's all that's really important. So let's talk about some important aspects that they're mentioning here. For the longest time, you heard that inflation's up by 7.5% year over year, and that the Fed keeps on talking about this assets purchasing. You heard that they're doing $20 to $30 billion every month in assets purchasing, and you're probably wondering, what the hell does all that mean? Well, funny enough, did you know that the Federal Reserve has a website? It says right here, Board of Governors of the Federal Reserve System. So this is where, allegedly, they're very transparent about what they're purchasing. So this is where you find the $9 trillion that they're talking about. You go to federalreserve.gov, you go over here where it says data. When you click on data, there's all this stuff here, okay? But to make it easy, we just click on data, and let's look at factors affecting reserve balances. H.4.1, which is basically a summary of all the stuff that they buy. Okay, here's the many different years. And we're going to do a little bit of compare and comparison just for fun. Let's look at the 2022 February 17th. We're going to open this up in this window. And then we're going to pick a random year. Let's pick February 22 of 2008. That's a good comparison. Okay, so when the Federal Reserve is talking about that they need to get rid of their assets portfolio, they're indicating here that they have nearly $9 trillion. And it's right here. Number one, factors affecting reserve balances of depository institutions, that is. You'll see here that securities held outright, which are U.S. Treasury securities, which include bills, bonds, mortgage-backed securities. Basically, there's a whole lot of numbers right here, okay? All the numbers are right here, and these are in the millions of dollars. So basically, we're looking at not just millions or billions, we're looking at trillions. So the magic number is all the way down here. Total factors supplying reserve funds, all right? And it says here, $8.9 trillion, or 8.9 trillion, 600 billion, 532 million. That's a whole lot of money. But that's basically where the government, or, well, we say the Federal Reserve, but we really mean the government, but they can be the same thing. But let's not talk about that now. Let's talk about what they're saying here. So basically, the Federal Reserve has basically put money into the economy by buying bonds and other securities, which are effectively, let's say, so many words, stocks, mortgage-backed securities. This is how they propped up asset prices. By asset prices, we're talking about the stock market. So basically the Federal Reserve is saying that they have nearly $9 trillion artificially put into the market. And this is what helped bring the stock market up, because they were trying to make sure that the economy, or rather that the stock market, didn't outright crash when the pandemic happened. Now, whether you believe that this was good or not, which I don't believe it was good, but that's my opinion, it did lead to record growths. And that's because when you just start putting money in there, anything can look bigger when you just print more money. And I'm going to go to this Federal Reserve website that I can also find how much money they printed. That'll be in a later episode, which is interesting to see. But this is what causes inflation, is that they take this money and put it into these assets and then artificially bring them up. Now, if you think it can't be that much. I mean, it's $9 trillion. I mean, the national debt is $30 trillion. What's the big deal? Well, if you're looking at the data 4 years ago, the total factors supplying reserve funds was originally, shows right here, 4.4 trillion, which means that we effectively doubled the amount of assets that were owned by the Federal Reserve. This is why we have record growth in the stock market, is because you basically doubled the amount of money that is invested by the Federal Reserve. They basically wrote a check to themselves to go and buy this stuff, and now they're going to go ahead and sell it. And rather than selling it and then reinvesting it, they're just going to, I guess, wipe it off the books. Let me see where they basically said that and in this news article, but basically it says right here, Ms. Bowman said the Fed's recent purchases of Treasury securities and mortgage-backed securities, which will end in early March. That's why it's also a bigger deal, because they're looking to raise interest rates plus, in this case, end all purchases of securities. She says that this has been an unnecessary form of stimulus for the economy, depending on who you ask. In the coming months, she said, we need to take the next step by allowing more securities to mature without the Fed reinvesting them into new ones. Meaning, they're going to sell those securities and they're not going to artificially prop up the stock market. And this is what people are freaking out about. That's why you hear, oh no, the economy's going to crash. Oh, we're all going to die. You better sell everything. That's what you hear. But it depends on your mindset and what your investment strategy is, guys. If you have a long-term strategy where it doesn't really matter what the market says, you just buy, would say, long-term holds that would say you buy stocks or ETFs where you just put in the money, you find it at a discount, and you're not looking at it every single day. You're not even looking at it every single month. You might look at it once in a while. And if that's your investment strategy, then this is probably a good opportunity to just go and buy some cheap stocks. Now, they're also saying that everything's overvalued, which, yes, there's about $4 trillion more than there was 4 years ago. So they're basically saying that everything's going to go down. And when the markets are propped up by this basically artificial money, this might be translating over to other sectors like cryptos, where people are making money in the stock market, and then they're taking that money and putting it in cryptos. And it's just a effect where now cryptos are no longer going against the market, or separately, they're not correlating with the markets now. At least that's the current idea. That's the current trends. So what am I saying with all this? Rather you think that the economy is going to crash and burn and we're all going to die, financially that is, or you think that, hey, we're just going to be just fine because things are going to regulate, and you know what, we're going to go to the moon with our crypto investments and our stock investments because this doesn't mean anything, or you're just not part of the market whatsoever, which makes me wonder why you're on this channel if you don't care about such things. But whatever your strategy is, just make sure you have a strategy. If you have a short-term strategy, maybe you should get out of the market because, I don't know, there might be a lot of market bleeding in the next 6 to 12 months. So maybe you don't want to be in the market. Or maybe you don't care because you buy things on the cheap anyway, and you're just going to keep it there because in the end, year over year, most people beat the market by just making 10 to 11% every year by just doing passive investments. Maybe this is your strategy. I know this is my strategy with some of my investments, not with all of them. I do have a trading portfolio. I have a long-term portfolio. I mean, whatever it is, just make a plan. And yes, maybe the economy will go down a little bit, but just, assess what your investment thesis is. I'm not your financial advisor. I'm no one's financial advisor. I am my own financial advisor. And what I do is I have my long-term and my short-term. And because of that, a few market hiccups don't bother me all that much. I mean, literally, we are freaking out because of a half a percentage point. I mean, most of us don't worry about 50 cents when we're spending $100. That's what this effectively is. But in the grand scheme, people want to make hay and probably raise hell. But these are just my thoughts. What do I know? I'm just a guy with a camera on my face. But that being said, if you like what I do around here and wish to support me, please check out the description below on ways to do just that. If you want to invest in cryptos and stocks, got links right there. If there's any news or happenings that you want me to report on, that'd be pretty awesome. Just mention it in the debate and comment section. And until then, I'll see you in the next video. And thank you so much.